Well, welcome back to Finance Uncut. On today's episode, stay tuned to the end to see how Francis Hunt's price target for silver goes from $175 to $5,126 an ounce.
You know, you talk about the possibility for getting to quadruple digit silver. So at that point, doesn't it seem kind of redundant to be measuring gold and silver in or relative to, let's say, the US dollar?
I think you're quite right. I think that the time that you would measure it for at that value will be probably very much as we're about to be transitioned into a quantum financial system or into a central bank digital token. But you'll, in effect, when you calculate your conversion and you repledge your physical silver for your whatever the new currency order of the day is, and you take the mark that dollar last traded at before it ceased to exist, assuming that it's terminated entirely or becomes a Fed coin of some variety, you will in effect see that in fact you would have a quadruple value. I'm not trying to be the guy that throws out the biggest number. I don't like those contests. I also keep an eye on the crypto markets and everything. And I'm not one of going, a million. If it doesn't have a technical merit, then I don't do it. What I will say is if you look at debtclock.org, in fact, they have 4,900 if you take the 1913. Now, that doesn't mean you get specifically to that date and period when that will ever be cross-referenced. But if I just show you here, right now, dollar to silver ratio right now, 4,943. It was 266 per ounce ratio in 1913. If you take the amount the dollars effectively devalued, compounded for all those years from 1913 to where we stand today at 2021, that's a lot of compounding over a lot of years. You've got $5,000. So I'm almost being modest by saying 4 digits. On your gold, you've got 35,000 per ounce. Now, they're going to try and get us off the physical. They want to, if there's a surveillance state, I don't want to go down that rabbit hole too far. They're going to not want to have you become too physically orientated. They're going to transition us to something which is highly tracked, which will either be through the blockchain or some quantum financial system, as I say. But there will be a period where you'll check and you will be able to bridge, I expect, everything you've stacked, if you want. I wouldn't do it all personally, into whatever new system is reestablished. But there's no doubt that this is a synchronized global reset for me. And, many countries that aren't on the dollar. So you also asked about the dollar milkshake and the dollar currency. I didn't fully answer all aspects of that. There will be a key moment where the currencies will fail, and they'll fail from the periphery. This is why I've got the gold versus the Turkish Lira chart here for you. I've not log scaled it, by the way. At one point, it was 64.77 Lira for an ounce of gold. It's now 13,538. That point wasn't that long ago. It was 1998. So you've gone from 64 to 13,500. So to someone in Turkey who's fiat, and remember, the lira is just a smaller version of the same issues as the dollar. And the dollar's benefited by getting people that escape the lira into the dollar. So it buys more time. So you have to think of this medieval village. The poorest people lived outside the walls. When the enemy Vikings came to attack, they were sacrificed. Then you had walls within walls. The king was in the middle and the most fortified place. You had to bash a few doors down to get to him and the monks and all the people who had the power in those areas. And then you had, concentric walls. What's going to happen is the periphery fails, and then they get ever tighter. And the more the periphery fails, the more you actually, for a temporary period, push up that in the middle, because people that want to escape lira will also buy dollars. They aren't all buying gold and Bitcoin. They might buy a little bit of gold and silver, and some of them may even engage in crypto markets. But for practical purposes, they're going to need something that's recognized easily accepted. And so you will actually get the dollar strengthening. And that's the final shoe to drop when you have gold and silver shooting up on a strong dollar and you have global currency collapse. I don't know how many of the guys noticed that the Turkish Lira had one of the biggest gaps I've ever seen in a currency on Monday. And Erdogan fired another central banker for, I don't know, the third or fourth time. And he's told jewelers that their gold vaults must be pledged with the government. So he's utilizing the old millennia standard of fortifying and trying to instill confidence in a fiat-based currency. And this affects jewelers who are sitting on inventory of gold. So if that doesn't tell us something, I don't know what does. I think they're able to control gold because the degree of industrial use, jewelry basically, is relatively small. Mm-hmm. And there's a large amount of bullion, and they can do what they need with stocks. Silver is a problem for them because of industrial use, and they've essentially kept a fake discount window open. That's my personal view. Mm-hmm. Everyone can use that discount window. But the point is most people aren't being encouraged to do it because it's not government mandate. You'll have all your celebrities telling you to take a vaccine and they've just had theirs. You won't hear them telling you to buy silver because it's common sense and it's good financial sense. And the last thing they need is a lot of people withdrawing that. There is over here on this side, and I've heard on stateside as well, from the material I'm watching, there's delays now in getting supplies on certain things, and there's reduced access to that. So we've just got to keep stacking, and the eventual will happen. I mean, you can build a wall on the beach, but you don't hold back the tide. It's just one of those things. And that's why I call it the great game of patience, where your trade is wrong, and then suddenly brutally right. Mm-hmm. Because when it adjusts, it is literally releasing the greyhounds from the leash. And that will unfortunately coincide, I expect, with lots of other social drama and many other aspects that we're not here to get into. I have a Reset Sniper channel and people can, shoot the breeze about that there. But I expect turmoil generally, and it will be hidden. It will be masked on the back page that silver is making all-time highs, gone up X%, gold is doing this, and various other aspects. And one of the charts we absolutely need to ensure we have a little visit on is the gold-silver ratio.
Which that's actually what I was going to ask about next is you really see that could go much lower. So how do you go about analyzing that, Francis, and where do you see it could get to?
Yes, let's bring it up and discuss it. So we at 113 after a blow-off move to gold, and the blow-off move on the gold-silver ratio, which coincided with the COVID, which is why I keep saying this pandemic was the seminal bookmarking event. Mm-hmm. And I will really, if guys get anything from me today, understand that was cycle change. That was a whole bunch of things changed, tangents. And I think that's kind of how it was intended, but that's maybe me. Maybe I'm a fruitcake. People can make their own minds up. But the point doesn't matter. The charts are illustrating that. So I'm just going to take the eye off and show you the annotations we've got for you, because we've got quite a bit of history here of gold. I mean, I'm a chartist and I love looking at it because to me it's real data. It's not fakery. Somebody had to trade real money here. And this represents the closest thing we've got to some truths. And I'm a truth seeker at heart. So this is from 76, your gold-silver ratio. And this was a very interesting point that's going to come out of this discussion, Tom, is that the last precious metals bull market was a completely truncated bull market, in my view. Mm-hmm. In other words, you had the 80s bull market, and you got a half-cast bull market that occurred in 2011. And the brakes were pulled up on that.
So you're speaking particularly about the bull market from 08 to 11, and you're saying that it was truncated and basically stopped in its tracks, right?
Correct. And it's kind of proven when you look at the chart. So I've got my stylus pen, and I'll just show you if your guys, for those watching and for those listening, I'll talk you through it as well. Essentially, you can see this green box over here was your 08-11 period. You can see that there. And in that, you got a 30.5 low and an 88.2 high. What am I talking about? The gold-silver ratio. So at its lowest point, which was the peak for gold and silver, so just again, so that we don't lose, guys, when the gold and silver ratio is deep down low, that's when we're spiking up strong on gold and silver. It's just that silver relatively outperforms and has a higher beta. So at that point, 30.5 ounces of silver bought you 1 ounce of gold. Before we had the collapse, you hit a high of 88.2 in that blue box area, which is around that green area. That was why I say it was a half job. The 80s market, so if I just clear that off, the 80s market, which was a full bull market in my view, you traded as low as in 1980. So remember, this correlates with Volcker and the bonds. This is why people aren't tying gold and silver analysis with debt analysis. Gold and silver is the anti-debt because debt is money, fiat money. You've got to understand, I call these the anti-fiat. Gold and silver is an anti-fiat. And you've got to look at the debt markets because the debt markets is the fiat creation mechanism. And that's another key point if you take anything. And this is something that I feel I bring unique to when I discuss gold and silver markets with people. A lot of amazing guys. I love them all, by the way. So I've got nobody to knock. They are, they talk about practical supply issues when they're trying to buy and also very useful. But when you do this kind of analysis, this was a pivotal event. That's Volcker in the dark blue box here, 16.5. That's 16.5 ounces of silver bought you 1 ounce of gold. That was in 1980. By the time we'd had our full collapse, which means the market had gone down from the all-time high, you hit a high of 102. You needed 102.1 ounces of silver to buy a single ounce of gold. So silver was murdered, down in single digits dollars during that period. And that was around about 90, between 91 and 92. And that's when you started to have the dot-com boom, et cetera, and people started to get a little bit more dis-ease with the free money. This is Max Greenspan. His irrational exuberant speech was 96 over here. And you had that set up and you collapsed from around about the 70s right down to the 40s. And then you had our half run, which took us to what we'd just recently done. We've only really just surpassed that. And for those that aren't aware of technicals, you get that first bull and you get a pullback. It's that next leg up that is the superseding mega run up that occurs that you don't want to miss. And I'm here to say, patience, fellow, your moment is coming. The debt markets are unraveling. And you've got to understand the relationship with fiat creation and the value of precious metals and how the debt markets is the canary in the mine for the fiat creation when it's finally gone too far. So overall,
Francis, just to go back to something you said just now, that first leg you believe has played out, and now we're getting ready to be able to, let's say, take advantage of that second, more powerful leg?
Correct. And if you continue with the observation that's going on with this chart, you'll see that we've made an all-time high on the gold-silver ratio. So I've taken the gold contract, just so that people understand what I've done charting-wise here. I've taken the actual gold contract. I've not taken anybody else's data. This is continuous futures gold divided by continuous futures silver. So that always will tell you it's going to divide the gold price by the silver price. How many ounces do you need of one for the other? Now we super spiked again that bookend event on the gold-silver ratio to 126 in this orange box, and it all was March last year. And we got, and this was a rising wedge. Again, this is a squeezing structure where you eventually get the blow-off out the top and then you capitulate down. A rising wedge is actually a bearish structure, but sometimes you get a final melt-up. And of course, we got this extra normal event that occurred, and silver fell really hard. Gold fell a bit, but not nearly as proportionally much. We had a blow off top where you actually needed 126.6 ounces. Now, you talk to First Majestic's CEO, and he tells you he's pulling out 8 ounces of silver tops for every gold ounce he's pulling out, in terms of what he's able to find. There's very few dedicated silver miners out and out. It's a byproduct for people pulling out gold and copper as much. So there's very few pure plays. There's not none, but there's very few. And the rarity of silver is being undervalued immensely. So at 113, when we were coming back down, we called major bull on that we saw the reversal of what was a blow off top, and we were all fully in those hunt volatility funnel trades, trading long. And that makes me my happiest because I'm stacking long, but instead of trading against my investment position, I'm now trading with it. And we had an amazing run, but we took off at target, and you can see why, because actually it wears you down. It has come off. It's traded sub 1700, I think, possibly since the 2040 high. But look at this. The further you blow off to the upside, another key technical point that people should learn, as extreme as you swing in your insanity to one direction, so emotionally you will get an excessive swing to the downside. Now, I have 16.5 at the last bull market and 102. You have 126.6 excess move in an absolute deflationary, switch the entire world economy off moment. I mean, it's absolutely crackerjack. It's mental, but let's set that aside. It is probably the most extreme economic stop switch that's ever been pulled globally and synchronized, as I've now started to mention. And this is the big problem. We've got too much synchronization, not independent opinion anymore. And the blow off to the downside, my personal opinion is, you'll get 9.9 or lower. In other words, you're going to get single digit again. And then you listen to First Majestic CEO. Sorry, I can't pronounce his surname, and I've not got it in front of me. I think it's
Keith Neumeyer.
Keith Neumeyer, thank you. I don't want to do him a disservice. Sounds a cracker gent. Telling you only get 8 ounces for every ounce of gold. And it ties totally with our single digit gold-silver ratio. Now, if we were single-digit gold-silver ratio now, as of gold's price right now, you would be at 175 odd. I'll check the exact price for detail, but you'd be at 175 if we were 1:10 for silver. Now, in the event of we getting down there, gold has gone up from 1,050 to it hit 2,000 during this period. So gold's not going to be standing still itself. Gold gets to 3,000, 4,000, maybe 5,000 in this complete reset, because this is going to be exceptional. I'm expecting supply lines going down. We focused on, preparing people for wealth, but also other preparation for this reset that's going to happen. I'm afraid the bigger the problem, the bigger the solution. They've got a big solution they want to bring down on us. So they need a big reaction, a big solution. I won't go further down there, but I'd say to people, think the unthinkable in terms of your preparation, and don't let it only be financial. But that aside, sticking to the gold and silver aspect, we've got a long way to go on gold. And if silver's going to be 1/10 or less, which is our forecast, and Steve has given you 1:8 on the mining coming out, that's a very big silver number.
Mm-hmm. In previous videos, I've talked about Keith Neumeyer from First Majestic, talking about the ratio of gold and silver that is mined now. That the ratio is 8-to-1. So for every 1 ounce of gold that is mined, there's 8 ounces of silver that is mined. And so when we look at that, this is and I've talked about what the price of silver could be in relation to gold on a gold-silver ratio. And Francis basically gets his target with the US debt clock, and that's over here, the dollar to silver ratio, which is at $5,126 an ounce. And if you actually go back and look at when after World War One, when both Germany and Britain went back onto the gold standard, they did things where they cut their currency supply, which one had a deflationary depression, the other one had an inflationary depression. A lot of sound economists in the Austrian school, and even some other people who don't subscribe to the Austrian school, such as Jim Rickards, talks about the need to work out to avoid, if there's some sort of reset where we go back to a gold or silver standard or a bimetallic standard or something that actually that anchors the currency, gives people confidence in it again. To avoid a deflationary or a hyperinflationary depression, you need to work out the number of dollars outstanding and divide it by the number of or the amount of silver or the amount of gold. And this is where Jim gets some of his really, really high gold target, his target for gold. And if you can see on here, gold is actually $36,614 per ounce. And silver is $5,126 per ounce. And that's just, looking at the amount of dollars that are being created, the M2 currency supply. So you can come to the USDebtClock.org. I'll put a link in the description below. But this is where these targets are coming at. So depending on where you think the gold-silver ratio is going, I think it's going much, much lower. As Francis said, that gold will continue to rise. So that target of $175 based on the current gold price is likely to be much higher because gold is likely to move up. Gold doesn't sit still while silver moves up. Gold moves up as well. It's just that silver moves a lot quicker. So I think that's a target that I've definitely got triple-digit targets. Francis and others have got quadruple digit targets. I guess we'll wait and see. Obviously, if it's quadruple, then the economy and this world that we're living in is not going to be a very fun and enjoyable world. It's going to be very, very difficult. But those of us who have been stacking, those of us who do have the physical silver and gold, will definitely protect ourselves a lot more by doing so. So what do you guys think? Love to see your thoughts and opinions in the comments below. If you haven't yet, hit that like button, subscribe, hit the notification bell. Everyone take care, and I'll see you again on another episode of Finance Uncut.